Hello everyone. For this project, I chose Paramount Global, one of the largest media and entertainment companies in the world, with businesses across television networks, film production, and streaming services. I selected Paramount because the company is currently facing significant financial and operational pressure during major transition in the media industry. Traditional television revenues continue to decline as consumers shift towards streaming services, while competition from companies like Netflix has intensified. In addition, recent merger activity involving Paramount and Warner Bros. Discovery has increased investor concerns surrounding leverage, profitability, and long-term financial stability. As a result, Bloomberg's default risk metrics and credit ratings suggest that investors and rating agencies are becoming increasingly cautious about Paramount's credit outlook. Looking more closely at the Bloomberg metrics, Paramount currently has a one-year default probability of approximately 3.27%, while its 5-year default probability exceeds 10%. These are relatively elevated levels for a major public company and suggest that investors continue to view Paramount as financially vulnerable over the long term. Bloomberg also assigns the company an HY4 default grade, placing Paramount in a speculative or high-yield territory. Another important indicator is the company's elevated CDS spreads, which suggests bond investors are demanding high compensation for taking on Paramount's credit risk. A major driver behind these metrics appear to be leverage. Bloomberg's data showed very high liabilities relative to EBITDA, meaning the company's debt burden remains large compared to its earnings generation. Combined with declining television revenues and increased spending to remain competitive in streaming, these factors help explain why the market continues pricing an elevated financial risk. These Bloomberg default risk graphs show how market perceptions of Paramount's financial risk have changed over time. One thing that stands out immediately is the sharp increase in default probability during periods of heightened uncertainty across the media industry. Investors become increasingly concerned as traditional television revenues weaken and companies throughout the sector spend aggressively to compete in streaming. Paramount's risk portfolio also became more volatile during periods of merger speculation and restructuring discussions, which increased uncertainty surrounding the company's future leverage and profitability. Bloomberg's credit rating analysis data shows that Paramount currently holds mixed ratings across the major credit agencies. Moody's rates the company at Baa3, which is the near bottom of investment grade territory, while both S&P and Fitch rate Paramount BB+, classifying the company as speculative grade. The ratings history also shows gradual weakening in Paramount's credit profile over time, reflecting the growing pressure facing the traditional media industry. These ratings suggest that agencies still believe Paramount can meet its debt obligations, but they also recognize that the company is increasingly vulnerable to weaker business conditions and industry disruption. What is particularly interesting is that Bloomberg's market-based default risk measures appear slightly more pessimistic than some agency ratings. This suggests investors may be reacting more aggressively to merger uncertainty, declining television revenues, and long-term profitability concerns than rating agencies currently are. In other words, while rating agencies acknowledge elevated risk, the market itself appears even more cautious about Paramount's future financial stability. Recent news developments help explain why Paramount's credit profile remains under pressure. One major issue is the continued decline of the company's traditional television business, including failing advertising revenue and ongoing paid TV subscriber losses. These trends weaken Paramount's long-term cash flow generation. At the same time, streaming competition from companies like Netflix has intensified, forcing traditional media companies to invest heavily just to remain competitive. Merger activity involving Paramount and Warner Bros. Discovery has also increased investor concerns surrounding leverage, restructuring costs, and regulatory scrutiny. Overall, the Bloomberg data and recent developments suggest that investors remain cautious about Paramount's long-term financial stability as the company navigates industry disruption and merger-related uncertainty.